Honorable Mrs. Natashya Rahman, our distinguished guests, ladies and gentlemen, good evening and Assalamualaikum warahmatullahi wabarakatuh. First of all, I would like to welcome to this presentation for this evening slot. My name is Dr. Nur Hazrin Abdul Hamid, and I will be your moderator for this evening session. Okay, so for your information, to get your e-certificate for this slot, please be reminded to sign in at the Google Form attendance at the chat box, okay, of Zoom at the end of the session. So make sure sign in and fill up the form for your attendance. Okay. So before we start our sharing session for this evening, maybe we can have our photo session first. So please, all students, turn on your camera. Dashini, okay, are you ready?
Yes, Doctor, I'm ready.
Okay, thank you, Dashini. So please turn on your camera. Okay, so we have our photo session to do. Okay, before we start our session. Okay, Dashini, kalau nampak semua dah turn on their cameras, you can just snap the picture.
Okay, Doctor. I wish everyone could open their camera. We haven't reached half of the participants who opened their cameras. Is that okay, Doctor? Can I proceed?
Yeah, sure, just proceed.
Okay.
Okay.
I hope you guys can give a big smile on your face. Okay, 1, 2, 3. Once again, 1, 2, 3. I'm going for the next slide. 1, 2, 3. And the last slide. 1, 2, 3. Okay, Doctor.
Okay, thank you, Dashini.
Welcome.
All right. So once again, good evening, everyone. First of all, I would like to thank you again for joining us for today's session, slot 4, for International Civil Industry Week at Faculty of Engineering Technology 2023. Okay, in this session for slot 4, we would like to have a presentation and sharing session regarding sustainable finance. I hope that from this presentation or from this sharing session may help the student, especially engineering economy student, to do and to start to do their project financing. So if you have any questions regarding your project, please ask our speaker here, Natashya, or just drop your question at the chat box. Okay. So before the presentation begins, allow me to introduce our beloved guest for this session. Mrs. Natashya is an experienced executive with a demonstrated history in corporate finance in Securities Commission Malaysia, and she involved in project on revision in capital market regulation and relevant guideline issued by the SC. She now serves as a manager at the Takeovers and Mergers Department, Security Commission Malaysia. Without further ado, I would like to welcome our distinguished guest. Okay, Mrs. Natashya, are you ready?
Yes,
can we hear your voice? Okay, to deliver. Okay. Please, the floor is yours.
Okay, thank you so much, Dr. Hazrin. Okay, hi everyone. Hope everyone's doing fine in this evening. I believe you had a slot in the morning, so I'll try not to make this too dry for you to run through. Okay, basically for sustainable finance and project financing, it's I understand that it's not on your it's not your day-to-day knowledge or say day-to-day work, but I'll try and make it clear and simple so that you are able to understand and utilize the knowledge for your group assignment, which I believe Dr. Hazrin has already shared with you. Okay, so before we go to the serious matter at hand, maybe I can just probably start off a bit more casual and laid back, okay? So first of all, okay, I'm actually 29 years old. Okay, I'm considered a millennial, which I believe most of you are probably in the generation Z, right? Born in 1996 to 2010. I actually I graduated with a bachelor's in accounting and finance from City University London. All of you here, I understand, are students in the engineering technology faculty. So of course, being engineering students, I understand that this may not be something that you are very familiar with, but inshallah, I will try and bring you through it so that you can appreciate what is finance and how can you apply in your engineering work later when you graduate. Okay, I was from an all-girls boarding school in Seremban. So yeah, I actually went through my entire study years being in all-girls school, right from primary until secondary. I started working in Securities Commission Malaysia, which is called the SC, in October 2017. So this year coming to 6 years. I'm bonded for a period of 8 years because I was awarded a scholarship by the SC to further my studies. I'm the only child, so I actually like seeing people who have siblings, have big families. It's very nice, and being the only child, it's quite sunny lah, people say, right? Okay, I'm actually still a student. Aside from my working life, I'm actually doing part-time studies to complete my chartered accountancy papers. I'm actually having my final exam this July. So I understand you as students, the struggle that you face in terms of like studying and, managing your coursework, managing your exams. I do feel that too. So I understand and try to make it simple so that you, besides just having to deal with the exam, the most important thing is to understand what you are actually going through, because that knowledge is very important once you complete your graduation and you join the working life. Last part is, okay, basically I also have hobbies, although work consumes a lot of my time, but I have hobbies like I like to jog, play badminton, and I love watching Bollywood movies. So that's just a bit of myself before we go to the serious context matter for sharing today, okay? Okay, feel free to ask me any questions during the presentation. I believe Dr. Hazrin also will be asking several questions so that you can further understand what is finance all about, what is sustainable finance, how can you apply it in your engineering project, and so on. Okay, so as an engineering student, I understand that you want to appreciate, or you want to probably understand why is this finance module important. At the first place, why do I even need to study this module? Because I'm doing an engineering degree. Why is it important for me to know finance? Okay, so in the real working environment, for you to know just one subject matter may not be to your advantage. So you need to know several knowledge areas so that one, you can broaden your career option. For example, some of you may wish to be project engineers. You want to, lead projects in terms of, like, for example, building huge buildings or building smart tunnels and so on. But at the same time, building projects or building, all these large contracts and projects, it requires financing. It requires the capital, which is basically money. So if you can understand how to finance a project, you can understand what are the financial conditions impacting the cost of the project. Then you are at this position in the company where people will come to you and ask you, for example, okay, we have this project of say 100 million ringgit, but our company is quite small. We don't have the financial capacity. So what are we supposed to do? So that question, you as someone who has studied finance or at least understand what finance is all about, you are able to give your views and you're able to make a decision whether what kind of financing alternative would you want to undertake. So you don't need to wait for someone like me who's an accountant to come and tell you, oh, you need to do this and this. But you as an engineer who has understanding in finance, you are able to do that by yourself. So that is actually very value adding, and it will place yourself as an invaluable person in the working life later on. Okay. So what are we going to talk about today? Basically, it is just basically 6 main areas. Okay. So first of all, we're going to look at what is project financing, an introduction to it. Second, we are going to look at alternatives to project financing. So I believe you probably know a bit of companies, or maybe you've heard in the news, you've read in the papers. So we're going to talk about what are equity financing. Equity maknanya share dalam company. Bila you beli share dalam company, what do you get in return? And then when you have debt, basically is loans from the banks. So if you get loans from the banks, what do you have to pay to the bank and so on? Okay. Then we're going to look at project analysis. We're going to look at life cycle costs, work breakdown structure, and cash flow diagram. So these are all basically equipment or tools that will facilitate you to decide on how you want to go about with your project, right? And then you will look at financial analysis. Okay, this one may be a bit new, which is something you're not familiar with, but we're going to walk you through it so that you are able to understand and use it for your group assignment, which is the net present value method and the payback period. And at the end, when you understand all this, then we will go to the last part where we will look at what is sustainable finance. Because currently in today's world, everything is about sustainability. Everything is about basically is about saving the world, because there's just so much of for example, pollution going on. There's a lot of environmental damages that is caused by, say, construction and so on, right? So how are we able to use finance or sustainable finance to cure that? Okay, so far so good. Anything, feel free to stop me. Okay, all right. So first of all, what is project financing and why is this important? Okay, first, as I mentioned, for example, you have a project. Okay, you probably want to build, say you want to build a building that is called a green building. Okay, a green building means you probably don't emit so much of pollutants to the air. It's eco-friendly and all that, right? So of course you need money to fund the project, especially if it's eco-friendly and whatnot. The cost may be a bit higher. So you need to find ways to fund your project. That's one. At the same time, when you build the project or when you build the building, you need to make sure that you minimize the cost of financing, meaning to say that after undertaking the project, you as a company should be better off, not worse off. So that's where you need to think, okay, if I buat building ni, will I get profit or will I get losses? So if I will get losses, logically, you're not supposed to do the project. But if you get profit, if you get additional cash, then yes, you should go ahead with the project. But all this will depend on how you want to finance the project and what is the impact to the company. So sometimes, not all the time, this is where you have to think. Sometimes a company might want to undertake a project that is very expensive, but the reputation that comes with the project, I'll give you one simple example. Let's say Gamuda built MRT, right? Okay, you've read in the papers, MRT is very expensive. The government is trying to minimize the cost and so on. But why companies like Gamuda and other companies probably involved, they still want to undertake the project, although it's a very huge project. They need a lot of money for it because they will be known as the only company that builds the MRT for Malaysia. So it comes with a reputational benefit. So sometimes companies might want to take that into consideration when they want to do big projects, although they might not have the capital to do it. But at the same time, you still have to think. If it's very loss-making, then you might not want to proceed with the project. So that's where we're going to use the financial analysis methods later on. Okay, right. So proceeding to the next one. Okay, so project financing is basically, to put it in simple terms, is macam mana nak cari duit untuk buat project. So all this in the boxes you can see in the slide are actually methods for you to find the money. So you know that after you calculated the cost and so on, okay, you know that you need a certain amount of money to build or to proceed with the project. So now you have these alternatives for you to proceed with the project and get the money. So usually, if the company is big or if the company is, for example, a company that has a lot of cash, they can just use the cash that they have. They don't need to go to other external parties. For example, the bank, they don't have to go to people like you and me to buy shares. They don't need to do that. They can just use what the company has. But if the company doesn't have cash, what they will need to do is they have to go to external parties. So normally, what is commonly done is to issue equity. Okay, equity means issue share. So has anyone heard of shares? Are you familiar with the term share? Okay, probably share is basically, if I put it in simple terms, share is a unit of ownership. So for example, your company, your friend wants to do a business, katalah nak jual baju. Okay, your friend needs modal. They need the capital untuk beli baju so that they can sell the baju, right? Macam orang buat kat Carousel ke, orang buat online kan. So you need to buy the baju so that you can sell to someone else. So your friend needs the money. Probably your friend tak ada duit. So dia pergi kat you and dia cakap, okay, I have this company that I have built and I want to issue share. So I give this one share to you at the price of say 100 ringgit. So 100 ringgit tu means that you own one share in company kawan you. So if anything that your friend makes from selling the baju, that profit will go to you as a shareholder. Because you dah bagi dia duit untuk buat business. So takkan you bagi duit for free kan? You must want something in return. So in return, your friend has to pay you back. But not in the form of macam loan. Because it's not a loan. You just give the money for the share. So you will get something called dividend. Okay, so dividend might be something familiar to you. But dividend is basically the return that a shareholder will get. Okay, we will look into that more in more detail in the next slide. Okay, second is probably the company want to issue bonds. Okay, bonds mean something that is a form of a loan. Ini kira macam hutang. Okay, tapi beza dengan loan, bond is usually issued by a company. So for example, a company that wants to do a project cost hundreds of millions, right? Mungkin bank cakap dengan dia, okay, if you nak loan 100 million, I cannot give you because you company kecil. So the interest rate yang you kena bayar balik, basically the interest rate lah kan is very high. So companies might not want to do that. So what they do is they themselves issue the bond. So when you issue the bond, beza dengan equity is, if I issue bond to you hari ni, 5 years later, I will have to pay you back how much you have given me. So if let's say, for example, I issue a bond to Dr. Hazrin for 100 ringgit. Okay, which means I owe Dr. Hazrin 100 ringgit plus a certain percentage every year that I have to pay her. And then at the end of the 5th year, I will have to pay back Dr. Hazrin her 100 ringgit plus every year punya, in a way, the interest lah. So that's the difference between equity and bonds. Kalau equity tadi, the 100 ringgit I bagi, my friend doesn't have to pay me back, right? I just get the dividend every year. But bonds, no, I have to pay back at the end of the year. Okay. And then the last one is loans from banks lah. Okay, loans ni very simple. So basically, if I get a loan from a bank, then the bank will have to check whether I patut dapat loan ke tak. Do I have the capacity to pay back the loan at the end? And then the other thing that is very important, banks will usually ask for a collateral. So collateral ni macam dia nak jaminan. So dia nak jaminan in the form of okay, I bagi you loan, tapi what if you tak boleh bayar I balik loan? So bank akan nak ambil something untuk jaga. So mungkin dia ambil kereta, mungkin dia ambil rumah, or mungkin dia ambil something yang nilai dia lebih kurang nilai loan yang the bank has given to you. Okay, so far so good. Alright. Okay, the other part.
Can I ask, for loans from banks, usually how much the banks can give untuk certain company? Berapa banyak loans yang selalu dilepaskan lah jumlah ataupun
Okay, of course, the first thing is it depends on which bank you go to lah. Okay, depends on which bank you go to, and it has to be a bank that you know has that the bank is familiar with you. Okay, for example, I bagi selalunya if you go to a bank that you don't have any credit history lah, we call it credit history. So if you go to a bank that has no credit history with you as a customer, most likely they will not give you so much of a loan because they don't know your credit record. They don't know your payment history. So for example, if previously you have taken a loan from a bank to buy your car, right? And you have always pay your installment on time. So there's no problem on no default of your loan ke apa, tak ada masalah like you tak bayar loan and everything. The bank will be more confident to give you another loan and probably a higher amount. And of course, dia akan tengok juga your income, dia akan tengok your other, if you have other loans with other banks. So it depends on the company punya reputation. So just now I mentioned about reputation, right? So sometimes beza company yang listed on the stock market versus yang tak listed. One of the thing is that if you are listed, the banks are more comfortable to give you a loan because listed companies, one, are usually bigger. Second, they are supposedly more financially stable. And third, if you are listed, you tak boleh nak ada default in loan. The moment you default on your loan, you will risk losing your listing status. So the company will be more careful to make sure that they akan bayar loan on time and everything. Kalau the company is not listed, they have nothing to stop them from defaulting on a loan. So as a company, why would I want to care if I tak bayar? Because I don't risk losing anything. Whereas a listed company, I will risk losing something. So to answer Dr. Hazian's question, usually I believe if let's say assuming a company of a size, say the company is worth 1 billion ringgit, probably the loan that can be given is a percentage of what the company is worth. So probably the bank can give you 30 to 40%. So the bank can give you 300 million worth of loan. But if let's say your project costs you more than that, then you have to consider a combination of this financing alternative. So tak semestinya you have to 100% finance your project with just one type of alternative. You can use a combination. Okay, one very popular common method now is this box here. Kalau you can see the orange box, venture capital and private equity. Okay, why I say this is very popular nowadays is because venture capital and private equity, they like to invest in one high risk and high return investments. So for example, you as an engineer, you come up with this very innovative kind of project lah. Okay, you want to build, say, the first building that can for some reason menangani masalah kemarau or like menangani masalah environment or anything, right? So venture capital will be the first to come to you and say, okay, we want to help you finance this project because first, of course, you will get high return because everyone will look to you as the first company that built this kind of building. And second, it will give them a good name. So dia akan dapat all these benefits, so they will come and help you to finance. But you have to be careful because venture capital and private equity, they are very aggressive. So, for example, if they don't get the return that they want, the moment they don't get the return that they want from you, they will pull out their money. So when they pull out their money, then you will risk having to fund your project using other parts pula. Probably you have to go to the government to get a grant, or you have to partnership with other companies. So I think for MRT, Gamuda actually partners with other companies and they do a joint venture. So these are like alternatives that are available out there, but you need to think very carefully before you use any of these alternatives lah. That's why the ones yang ada green ticks tu, those are like the most common ones because they are the safest and they are the most common methods lah. Okay, so I can move on. Alright, so out of the 9 tadi, if we can just narrow down to the main types of financing that you need to know at this juncture. So this is very important because this relates to your project assignment. That's why I cakap currently, masa sekarang, these are like what you need to know. But when you start working, when you go to the real company situation, this previous slide, you will face all of that. So it's something for you to be aware of lah. Okay. So what you need to know now is basically 2 types, equity and debt. If you understand these two, then you are good to go lah. Basically, you can try and finance your own project already. Okay. So first, we will talk about equity. Okay. In terms of equity, like I mentioned just now, we have mainly 2 types of companies. So we have what is called a Sendirian Berhad, and what we have is a Berhad. Okay, a Sendirian Berhad is basically what we call a private limited company. So private limited, nama pun is like very macam kecil kan. Okay, it's private and it's limited. So meaning to say that I can only issue shares to not more than 50 shareholders. So I cannot have more than 50, 50. And I can only probably issue to people that are close to me, my family, my friends, people that know me. Okay, the reason is because these private limited companies, they are less transparent and there's less regulations imposed. So the SC, for example, the SC, we do not regulate private limited companies because private limited companies first have limited number of shareholders, and second, they're not listed. They're not listed on the stock market. So if you want to invest in a private limited company, of course it's a higher risk, but you have to invest at your own need lah. So basically macam you know that this company probably is they have good prospects, right? But you know at the same time, esok lusa company ni boleh tutup kedai. So you need to macam do your own research and decide on yourself because the regulators will not regulate for you this section. Okay. But the good thing about private limited companies is because it is less regulated, which means that you are free to explore more business models. So if you want to do something that is the first in Malaysia and you might not generate profit for the first few years, okay? So these are like companies that we call unicorns. Maybe you know of Grab yang bawa kereta and all that, right? Yeah. Grab was like the first unicorn in Malaysia. So Grab started off as a private limited, but then when it became bigger, it graduated, became a Berhad, and now it is listed in the US. So that's how the company will start to progress lah. Okay, you have to start small, then you gradually progress. Okay, comparing to a Berhad, so Berhad, you no longer have the 50 shareholders. You can issue to as many people as you want, which means you can issue to the public. Okay, you can have even millions of shareholders. No one will stop you. Okay, but the thing is, Berhad are of course subject to higher regulations. So for example, Berhad mesti ada audited financial statements, audited accounts every year. So every year auditor kena datang, check accounts, make sure numbers tu semua betul. And then at the same time, Berhad sekarang kena make sure that they have ESG compliance, which is called environmental, social and governance. Dia kena make sure dalam company tu ada at least 30% female directors. So there's a lot more things that they have to comply with. But tadi Sdn Berhad, like no one is going to tell you what you have to do because everything is on your own. But Berhad, you have the regulators macam SC, Bursa Malaysia, even maybe Bank Negara. So everyone will have requirements for the Berhad to comply with. Okay, but because of the regulations and because it's more transparent, maknanya kalau you Google, okay, for example, okay, maybe you know of Berjaya Group, tak macam Starbucks semua kan is under Berjaya. So Berjaya is a listed company. If you just Google Berjaya company, Berjaya Group Berhad financial statements, dia akan keluar how much the company has paid the directors and all that. So you know how much they pay their directors, you know how much revenue they get, how much profit they get. So there's a lower risk for investment because you know already roughly how much you're going to get in return when you invest in the company. Okay. And for you to be listed on the stock market, of course, SC will impose certain requirements. Macam you nak listed boleh, tapi these are like requirements that you have to comply. So requirement 1, you need to have after-tax profit of at least 6 million. And then requirement 2, you have to make sure that your directors are people with credible experience and all that. You can't just simply take someone to be a director. So benda-benda macam ni because of regulation, that's why it is a lower risk investment lah compared to this Sdn Berhad. Okay, so far so good. Okay, actually I have one question. If anyone nak jawab, can probably put it in the chat box or something. Okay, in Malaysia, rasanya berapa listed companies yang kita ada so far? You can just take a guess. How many companies do you think out there are listed? Tengok ada orang reply tak?
Ada Hanif Izani cakap dalam around 100
Oh, okay.
plus.
Okay, he's not far off. Tapi, okay. Orang ni, Amirul Afiq tu Google lah. I rasa dia Google. Okay, yeah. Amirul is correct. So, there's about 970 companies listed. Most of which are in the main market lah. So, kita ada main market, ace market, lead market. So most of the companies are in main market, which is macam the first level lah, okay? The first level, then you have the second level, and you have the third level. So kalau why I ask you that question is that so you know roughly banyak ke sikit yang listed, and at the same time actually kita rasa banyak kan dekat 1,000 company kan. But if we look at US or we look at Thailand, Indonesia, they have far more. Singapore, so kita rasa kita banyak, tapi sebenarnya orang lain lagi banyak lah. Okay, so that's the point lah. So we are trying to still grow our market lah. Okay, so mana tahu?
Boleh tak tanya, kenapa dekat Malaysia susah untuk like company Sdn Berhad become Berhad? Is it any regulation or sebab market Malaysia?
Okay, that's a very good question. In fact, that is what we try and think every day dekat kerja lah. Okay, one thing that when we usually what we do is we ask these companies directly what's the problem that they face. Okay, one very common problem that they mention to us is of course because the Malaysian market is quite limited in the sense that our investors, macam kita nak invest, or if you notice lah, siapa-siapa yang ada parents ke uncle aunties yang suka beli share, dia akan beli share company yang dia tahu je. Dia probably takkan beli company yang dia tak pernah dengar or buat benda yang macam kan pelik-pelik. Pada dia pelik, pada kita biasa je macam Grab. Mungkin Grab mula-mula tu orang macam aku apa ni, tak faham kan. So they don't want to invest in the company. They probably want to invest in companies yang buat cement or buat rumah. So benda yang they can understand, right? So because of that, companies sekarang ni kat Malaysia find it very difficult to get more awareness and more shareholders. So that's why Grab pergi kat US because the US market understands them better. So that's one reason. The second reason, of course, to a certain extent is our regulation lah. So our regulation, because market kita macam tu, regulation kita pun akan jadi quite tight lah. So we are trying to make the regulation a bit more liberal so that companies macam like we don't lose companies like Grab already lah. Kita nak try buat market kita lagi macam canggih, macam menarik. So kalau tak, market kita akan penuh dengan company yang dah matured companies lah. We want companies that are still growing. So mana tahu any one of you, students out there, right? You want to build something new, never be afraid. Just go ahead and do. Because the moment you follow what others are doing, you will not be different lah. You'll not be special. And for you to be special in the market, that's the key lah basically. Okay. All right. So moving on. Okay. So this is okay. So now we go straight into equity financing. Okay. So as I mentioned, shares are units of ownership or interest. So what are characteristics of shares? Basically, one, they're dividend paying. Then you will get this thing called capital appreciation, and there's this thing called transferability. Okay, so dividend paying is quite straightforward. You will get dividends when you buy a share. Okay, capital appreciation means, for example, hari ni I beli satu share, harga RM1. Okay, esok share tu mungkin worth RM1.20. So there's a 20% capital appreciation for the share. So, but capital appreciation is not something yang hari ni kita beli, esok kita dapat. It is a long-term concept. So you have to hold the share for a long period before you can actually enjoy capital appreciation. Okay, transferability is, for example, you can transfer the ownership. So for example, I have a share, I don't want to hold the share already. I can give my share to Dr. Hazrin. So it's called transferability. If, for example, tadi Sdn Berhad, I can transfer, tapi I can only transfer within that limited pool of investors sahaja. I cannot transfer to anyone. Tapi kalau Berhad listed, the transferability is higher because I can transfer to someone yang I don't know. I can just sell on the stock market. So I can easily get money from selling my share lah. Okay. Okay. So we have to think, because it's not as I mentioned, kita kena evaluate. We have to evaluate basically what are the pros and cons of doing equity financing. And this is something that you also need to take into account when you want to finance your project. Okay. First, when you do an IPO, which is called an initial public offering. So initial public offering means the process of becoming a listed company. Of course, when you do an IPO, you akan dapat this huge amount of money because everyone will start buying your share. So you will get, say, 200 million, 300 million. You will get a lot of money. Okay. But at the same time, if you look at the first row of the cons, right, despite sacrifice ownership of company. Okay, because for example, imagine this. You have a company and now the shares is only held between you and, for example, your parents. Then when you do an IPO, you have to offer shares to, say, 1,000 people out there, right? So sekarang shareholders company bukan you and your parents sahaja, but campur that 1,000 people. So when they have ownership in the company, meaning that, okay, like you own something, you want to decide on what the company does, right? Takkan you nak jadi shareholder and you nak macam, oh tak apalah, tak kisahlah company buat apa, buat je apa kan. Of course not. Shareholders will want to decide on what the company does. So when you sacrifice the ownership of the company, what happens is that you no longer control the company. So you have to give the control, or in a way share the control with the other public shareholders. So this is something that kalau let's say you baca financial section of papers macam The Star ke apa, you will see articles macam, oh, this company director nak buat ABC tapi shareholder tak agree, shareholder cakap tak nak. So shareholders can decide what happens to the company lah, because they hold the ownership of the company. Okay. And then the second row, in terms of the pro, there's better governance because shareholders are empowered. Okay. Why this is important? Governance ni relate to sustainability. So this one I want to focus a bit lah. Okay. Governance means that you want the company not to be controlled by just a certain group of people. So for example, maybe a company that you maybe have read in the papers, Sapura Energy. Okay, Sapura Energy has had this problem where dulu Sapura ni like everyone tahu, everyone looks up to Sapura and they have been profit making and whatnot because they do oil and gas. Oil and gas sekarang memang like is on the uptrend. But Sapura has been loss making. So people are asking, kalau harga minyak semua naik, kenapa company yang buat minyak boleh loss making? So it doesn't make sense, right? It's because the shareholders do not have a say in what happens in the company. The directors have too much power. So governance means you need to make sure that interests of all parties are served. So of course, you don't want the directors to be disadvantaged. And you don't even want the shareholders to be disadvantaged. You want everyone to get what they're supposed to get. Tapi when it comes to companies yang governance not so good, shareholders don't have a say in what happens in the company lah. Okay. And the last pro is in terms of no accounting liability imposed. Okay. This one is not it's not really very important for your project assignment, but just to explain, basically when we mention on accounting liability is more in terms of the financial condition of the company lah. So when you have a listed company, normally there's no liability imposed. So that is good for the company's condition lah. Okay, but when it comes to the cons here, dividend and all this, okay, this is something that you have to decide if you want to go for equity financing. Because as a shareholder, right, the dividend, of course you will get dividends, but let's say a company, katalah, company goes bankrupt. Okay, when the company goes bankrupt, the people who will get paid first are people that the company owes money to, which are called the creditors. Okay, shareholders will be paid last because company tak owe shareholders. Shareholders bukan orang yang, dia bukan pemiutang. Okay, tapi pemiutang are like people like banks or people yang bond holders. Shareholders are not pemiutang, so they will get paid last. So that's another con of this when you purchase a share in the company lah. Okay, so far so good. Okay, right, we move on. Okay, so as I mentioned just now, this is just for your additional knowledge and information lah. Okay, so when you want to become a listed company, you will undergo a process called an initial public offering, which is called an IPO. Okay, maybe you've heard of it before, maybe you've not, it's okay. So IPO is basically an exercise to list the company on the stock exchange. So for Malaysia, our stock exchange is called Bursa Malaysia. If let's say you go to US, you have the New York Stock Exchange, you have Nasdaq. If you go to Singapore, you have Singapore Stock Exchange. So every country will normally have a stock exchange, but certain developed countries, they will have more than one. For now Malaysia kita ada satu je lah, which is called Bursa. Okay, so parties involved in the IPO process normally ada four main parties here, which is the company that is going to go listing, the investment banks, which are banks like, for example, Maybank, CIMB. So they have these investment bankers to help the company. Okay, kerja dia is to help the company to prepare what is required for the process. So because ultimately the regulators such as SC and Bursa Malaysia will decide on whether can you be listed or not. So the regulators will require certain information from the company to decide whether the company can go for IPO. So who wants to help the company, right? Because the company of course takkan tahu. So the investment banks, the lawyers and accountants, these two parties will help the company to go for IPO, which is under the approval of the regulators. So that's basically the process lah. Okay, it's very simple, but normally the process is very time consuming. Okay, which brings me my second question. Okay, so how long do you think the IPO process is from the point where you submit the application until you get approval? How long do you think it takes? Tengok, ada orang 6 months. Wow, okay. Okay, this is very specific, and I think kalau I buat physical session, I would have probably given this person something lah. Okay, Hanif, just reply to the chat box. Oh, just while guessing. Okay, I thought you read it on our website. Okay, yeah, 6 months is actually the correct answer because what happened before? Okay, before 2022, we never had a standard timing. So for example, company submit, we will do what it takes, and sometimes it can go until 1 year, 2 years, okay? And imagine you have to do the same job for 2 years every day. So when it comes to the end of the 2 years, you like you just cannot take it anymore, right? Because you look at that thing every day. But now, what we decided is that, okay, we want to facilitate the market. We want to make it more attractive to go for IPO. So we set a timing where the SC will ensure that you will get your approval within 6 months. So whatever happens, 6 months from submission. Okay. So this is supposed to attract more companies lah. So like we mentioned just now, we are trying to make the market more attractive. So this is one of the ways to make the market more attractive. So we promise, so it's like a promise like that, the SC promises to give approval within 6 months. So if anything happens, tak dapat by 6 months, so then it's like our problem lah, no longer the company's problem. Okay. So yeah, good job lah. I mean, I really need. Okay. Maybe you can try and apply if you want to work in the SC. Okay.
Ada apa-apa bayaran tak for the company to pay for security commission or bursa saham?
Yes, actually that's a very good question. That's how we actually get get paid
Yeah,
our
yeah.
salaries.
Yes.
Okay. Okay. So currently, in the current fee, because now we are also looking to increase the fee, because the last time we actually revised our fees was 12 years ago. So for the past 12 years, the charge for IPO has not changed. Although companies have gotten bigger and larger, but the fee has not changed. So sekarang roughly, I would say everything, how much they have to pay to us. Okay, they pay to us not much, actually about 1 million in total. 1 million in total. But campur with, okay, the biggest chunk goes to the investment banks. I can say that for sure. Investment banks like Maybank, CIMB, they charge about, depending on the size of the company, they can charge up to 10 million. Okay, so 10 million. And then lawyers, accountants, they probably charge 4 to 5 million. Then regulator, 1 million. So regulator is the smallest lah actually. So in total, for you to go to IPO, and especially if you're a large company, for example, you katalah last time when Petronas Dagangan went for IPO in 2011. So that time they paid a total of about 30 million, 30, for IPO. Okay, but you have to compare it with their profit. The profit that they got at that time, 2011, was the uptrend. They got profit about 3 billion. So percentage wise, it's not big. So they can easily, spend 30 million lah, not a problem to them lah. But imagine a company that is just barely meeting the profit. Let's say profit dia dalam 30 million, right? Of course, they can't spend 30 million for IPO lah. So they will need to, then the banks and whatnot will reduce their fee. So the bank will charge the fee relatively to the size of the company. Tapi regulator fee pun dia akan relative to the size of the company. So we have a formula lah where we look at the company size before we charge the fee, to be fairer lah.
Okay, Natashya, we have a question regarding IPO. So maybe I just ask during this session, okay? So maybe you also can check the chat box. Yeah, how AMLA impact the IPO process and the AMLA requirement during companies. Okay.
Okay. All right. Okay. First of all, I'm happy and I'm surprised at the same time, because students nowadays, like, they know, they're aware of AMLA and whatnot. Okay. So to those yang not sure what AMLA is, AMLA stands for Anti-Money Laundering Act, right? Okay. So anti-money laundering means when a company has a lot of cash, and there must be like questions, or say for example criteria that we will look at when to make sure that the cash that the company has does not come from illegal activities or fraudulent activities. So simplest example, I want to give an example in that sensitive. Okay, for example, I have sold I've sold my properties, okay? I've gotten a lot of cash. That cash, that gain from selling my properties, I should pay tax. But I tak nak bayar tax sebab tax tinggi. So when I don't pay tax, that is already considered a fraudulent activity because I am reaching the requirement. So that is part of money laundering already. So that money, when I don't pay tax and I put it into my company, and then my company goes for IPO, so then these are like the things that will make the company. So how it impacts the IPO process is that, of course, we have certain internal procedures which I'm sorry I cannot share with Amiro or anyone here because it's very confidential. But I can say generally that once we flag a company for possible money laundering, what happens is that first, of course, the IPO cannot go ahead. We will stop with the IPO, and we will need to look at the money trail. So we have this system, or we have this sort of like we need to do some money trail to ensure that the money that is in the company does not come from illegal activities. So we have to do some investigation and whatnot lah. Okay. In terms of AMLA requirements that they need to fulfill during IPO, okay, there's these guidelines that we look at, which is called the equity guidelines. The equity guidelines doesn't specifically mention that there are certain AMLA requirements, because actually AMLA is under Bank Negara's purview. But what we do is we work with Bank Negara. So if Bank Negara has identified certain companies that are under possible money laundering suspicion, they will tell us and we will automatically flag the company lah. But in terms of AMLA, I wouldn't say SC is the main regulator. It's like a joint regulation with Bank Negara, because Bank Negara will know the money flow, because Bank Negara looks at money from overseas, money in Malaysia and all that. They look at the money market, whereas SC looks at the capital market. So capital market and money market is different lah. That one is for you to probably do a bit more research on and look at the differences. Okay, I hope I answered your question, Amirul. Okay. All right. Okay. So if there's nothing more, I'll proceed to the next one. Okay. Okay. So next is pros and cons of IPO. Okay, this is actually just again additional knowledge, but I'll just go very briefly on this. Okay. So when you want to undertake IPO, of course you have to think what's the benefit that I will get and what are the disadvantages, right? Okay, so first, if I undertake an IPO, in the future, when I want to do more projects, I can do other types of fundraising exercises that Sdn Berhad cannot do. So I will go through two types of it later in the next slide, but basically it opens up more capital or financing alternatives for you. So for example, when I mentioned the government grants or partnerships with other companies, as a listed company, government might be more comfortable to give you a grant compared to Sdn Berhad, because as a listed company, you have more transparency. So government will be more comfortable to give you a grant lah, because they know what you're going to do with it and so on. Okay. And then of course you will get a recognition. You are now a listed company, lower risk for investors and so on. Okay. Of course, the cons are, one is higher regulation. Okay. Higher regulation ni, you cannot think of it just that macam, for example you pergi sekolah and then you have all this requirements to follow, right? So it's not just like I have to follow requirements, but it's the cost that comes with complying with the regulation. So for example, I mentioned every year listed company must produce audited financial statements. To hire the auditor, you have to pay the auditor, right? So when you want to pay the auditor, that comes with money. So that becomes a cost for you. And then you also need to make sure that you are accountable to the shareholders, because the shareholders also own your company, and you must get shareholders' approval for every big exercise. So for example, in your group assignment, okay, you decide to do equity financing and you want to create a listed company, okay, you have to think that whenever you want to undertake a project, you want to participate in a tender, you want to go for a contract and so on, you cannot go and decide by yourself, you have to go back to your shareholders and tell your shareholders, okay, I'm going to participate this tender with Jabatan Kerja Raya or anything, or with the Kementerian any kementerian, right? So your shareholders must say yes. Only then you can go and participate in the tender. If your shareholders say no, then I'm sorry, you can't do anything. So you need to make sure that this is complied lah. Okay. All right. Next one. Okay. So these are like examples of fundraising exercises that you can do after you have become a listed company. So you can actually undertake rights issue, which is basically you issue new shares to existing shareholders to raise more funds. Okay. The key here is you issue to existing shareholders. So for example, if you want to do a rights issue, you can issue to new shareholders. Tetapi you kena offer dekat existing dulu. Okay, so existing shareholders first. If existing says no thank you, I don't have the money to buy, then yes, you can go to to new shareholders. Okay, the benefit to the shareholder lah is that usually it will be at a discount. So for example, kalau I beli dekat market, share dia RM1, tapi kalau rights issue, it will be probably 80 cents, 70 cents. So it will be at a discount. Okay. Pro rata is basically just for you to understand is I will issue it proportionately to everyone. So semua akan dapat equal. Okay. Bila equal, no shareholder will be at a better position. Semua akan dapat sama rata je. Dia macam sama rata lah. Okay. Second is private placement. Okay. Private placement is basically issuing shares to selected parties. Okay. Private placement ni is a bit more exclusive lah, I would say. So for example, you want to do a project. You might not want to do a rights issue because rights issue ni, the thing is, if you have done a rights issue last year, you don't want to do a rights issue this year because regulators will ask many questions. So you might want to do something called a private placement. So private placement, for example, you know some of your friends are very rich, they have a lot of money. So you go to your friend and say, you want to invest in my project. So you do a private placement just to the party that you have identified. And you just get money from that parties that you have approached. You don't have to go to everyone. Okay. So that's the two main, these are like the two main post-listing exercises. Okay. All right. So far so good, everyone? Okay. All right. Okay. So these are like questions that you need to take into consideration when you want to decide on proportion of equity to debt. Okay, I know this is one of the parts of your report. You have to consider the proportion, right? Okay, so now you have to think first, how much is the cost of the project? So for example, if you want to take a project and you know that the project costs you a lot, right? Compared to, okay, for example, let's say if you have a few alternatives, you know you have project A, project B, project C. If say one of the project is the highest out of all, and you don't think that you will have enough if you just resort. Alright, okay. Okay, tak apa, it happens. Okay, so when the cost of the project is quite high, you have to think which one is more suitable, and it's not just an all, okay? It can be equity and debt, can be a combination of both. And you have to also think what type of companies will usually undertake. What type ni, macam tadi we said, whether it's a senior berhad, whether it's a berhad, okay? And then when you know how much the cost is, then only you can think, can a bank give me that amount of loan? Or can the bank give me, how much can the bank give me? Macam tadi Dr. Hazrin tanya, how much can a bank give maximum? So if I know a bank can give me up to a certain maximum, I have to top up. So how much do I have to top up? And how do I top up that shortfall? Okay. And this is just, this is something for you to consider also. If let's say you choose to establish a public listed company, you normally will undertake substantial projects, okay? I'm not saying that public listed companies don't undertake small projects, but it's just logically because you are big. Why would you want to take a small project? And you want to devote your resources, your engineers, your technicians and all that, and you want to do a small project, which doesn't really contribute to your profit. So you will usually take huge projects, and these are like usually above 100 million. So then you have to ask yourself, can I get a loan for 100 million? Or can I get a loan for 200, 300 million? So if I cannot, then what should I do? Should I issue more shares? Should I do a rights issue? So those kind of things you have to take into consideration and think. If let's say you feel that you're stuck somewhere, I suggest just Google. Nowadays, everything is very accessible by Google. And of course, you can always ask Dr. Hazrin. I'm very sure that she will be more than happy to ask you and to facilitate you, right? Because usually as students, sometimes I understand kita segan nak tanya ke, or kita rasa macam tak apalah, I cari sendiri lah. The best advice is never wait until last minute. Always reach out to your lecturer as soon as you know you have a problem. Okay? So that's for this. Okay, now we go to the more technical part lah, okay, calculations. Do we want to continue or do you want to give them a break ke macam mana?
I think it's okay, just continue.
Okay, can continue. Okay. All right. So, okay. So now we talk about cost of equity. Okay. So, this relates to how much am I going to incur in terms of like when I do a certain financing method, how much am I supposed to pay back, right? Okay, this is not to be confused with cost of project. Cost of project is simply how much I have to pay for my materials, how much I have to pay for my labor, how much I have to pay for my machineries. That's cost of project. Cost of equity and cost of debt later, which you see, is basically the return that the shareholders or the bondholders require. Okay. So cost of equity ni is basically, remember just now I mentioned shareholders will be paid dividend, right? And dividend is basically what the company will pay to the shareholders. So that is called cost of equity. Normally it's in a percentage, and again normally it's higher than cost of debt. Why? Because shareholders have actually higher risk, because in the event that a company goes bankrupt, shareholder will be paid last. So for me to be compensated with the fact that I will be paid last, I should get a higher dividend compared to someone who is giving the company a loan. The logic is very simple. In finance, the logic is higher risk, higher return. You just have to remember higher risk, higher return. So if it's something that is high risk, I should get high returns. If it's something that is low risk or no, okay, what happens if there is no risk? Do I get any return ke tak? What do you think? So for example, no risk, like cash. Okay, cash is no risk. I have cash, that's it, right? Okay, so if I have cash, do I get returns on my cash? No, right? Because I just hold the cash. But if I put my cash in fixed deposit in FD, I will get a certain return. So that is because they use your cash to give loans to other people. So the bank is actually investing in a way for you so that you get returns for your cash. But if you just pegang cash in your wallet every day, like no one is investing for you, then sorry, you don't have any returns. So it's no risk. Okay. All right. So cost of equity is actually influenced by three main factors. One is volatility of shares. Volatility means how the share price fluctuate. Okay. So higher volatility means hari ni dia naik 30%. Esok dia turun 50%. Then lusa dia naik balik 20%. So it's very volatile. You cannot predict the behavior. Okay. Equity market condition ni is performance of Bursa Malaysia. So if you just Google like KLCI top 30 companies, there is an index that tracks the performance of these companies. So that's called in a way that is the proxy for equity market condition. And of course you have risk-free rate. Okay. Risk-free rate ni, just think about it as something that is minimal risk. So for example, Malaysia, okay, Malaysian government akan issue bond, okay, which is called the Malaysian Government Securities, or called MGS. So the rate that the MGS has is usually the risk-free rate lah. That is the rate that we will use. Okay. So when you understand cost of equity, this is one part of, cost of equity is actually what you will calculate from your capital asset pricing model. Okay. Anyone has heard of capital asset pricing model before? No one? Okay. All right, no problem. Okay. Capital asset pricing model, if you look at this, okay, this is actually, if I want to relate to you, like engineering students, I think you are more familiar with like scientific motions, right? Okay. This is your Y variable, right? This is your C, your constant. And this is your beta is your M. M is gradient, right? M is gradient. And this is your X variable. This is your independent variable. Okay. So this in the bracket is called expected return from market minus expected return from share. This in essence is called equity market premium. Okay. So for you to calculate just now what we call expected return from share is actually cost of equity. Yeah? So your Y variable is actually cost of equity. This is the formula that you have to remember. It's not difficult. Finance is not like science where you have to calculate very difficult things. It's very straightforward most of the time. So this is the formula for you to get your cost of equity. Okay, and these are the information that you have to get lah. Okay. All right. So once you calculate cost of equity, then you need to think of cost of debt. Okay. So as I mentioned, kalau okay, let's say we borrow 1,000 today, do we need to pay back only 1,000? So two things that we just have to pay back 1,000. If you find a bank that can just ask us to pay back 1,000, do let me know, okay? Like we really need to use that bank. Because as of now, I think the minimal rate for you have to pay like 2-3%. And of course, nampak sikit 2-3%. But if let's say you are to pay 2-3% for a period of 30 years, sometimes it becomes more than the principal, right? So the interest is a very key component. So this is where cost of debt. This is what cost of debt is. It's called the effective rate of a company that to pay on its current debt, right? So this is the formula. Okay, you don't really need to calculate the formula most of the time. This is just something for you to understand that the cost of debt is usually on a compounding basis. Compounding means, for example, very simple example, maybe some of you have bought cars, right? Or maybe your parents bought you guys cars. Okay, so when you buy car, usually a car loan is for example, maximum 9 years. Okay, so the interest that your parents or you have to pay for the loan of the car, it compounds every year. So it's not the same figure every year, okay? It compounds. So when it gets compounded, the interest becomes bigger and bigger and bigger. Up to a point where if you total up the interest that you have been paying to the bank, the interest sometimes becomes more than the principal. For example, you beli Azia. Azia mungkin 35,000, right? You calculate by the interest yang you bayar to the bank, the interest can be more than 35,000. And that becomes the total loan for your 9 years. So then, the next question is, then kenapa? Tak payahlah buat 9-year loan kan? Buat je lah 5-year loan tu or beli je lah cash. Right, yeah, okay. That is something that only certain people have privileges to pay in cash and whatnot. Most of us will need the loan lah. But you just need to know that in your future, if you want to take loans and all that, the interest is very important. You really need to look at the interest. Okay. This is more like personal finance knowledge also lah. Okay. So now you already know the cost of equity and you know the cost of debt. Okay, how do you want to use these two? What's the relationship? So the relationship comes into this formula called weighted average cost of capital. So these are like the key questions for you to understand what is weighted average cost of capital. So what is it? Why is it important? How to calculate it? And what is the difference between this thing for weighted average cost of capital with the hurdle rate? Okay, 4 things. So we go through it one by one. Okay, first, how to calculate WACC? Okay, so if you look at this formula, you will notice this part, RE and RD. Okay, RE is basically your cost of equity. So tadi kita dah belajar kan? Kita belajar calculate cost of equity guna CAPM, Capital Asset Pricing Model. The cost of debt normally will be given because it's just basically how much the bank will charge you. Then you have these fractions. Okay, these fractions basically is the proportion of equity in your financing. So for example, you have a project that costs you 100 million. You want to finance 50% equity, 50% debt. So it will be 50 over 100 and here also 50 over 100. Okay. Okay, the other thing is this part, the last bracket here, 1 minus tax rate. Okay. Anyone knows why do we have this thing here? Maybe a wild guess. Let's see if the wild guess comes from the same person or not. Okay. It's okay. No one, then tak apa. I'll explain. Okay. You see, if you have incurred a debt, right, as a company, you have taken a loan and you have paid the cost of that and whatnot. this is actually the tax deductible. Tax deductible maknanya you have a, okay, for example, like you pay taxes, right? Maybe at this juncture you don't because you're a student, but later on when you start working, you have to pay income tax. So companies also will pay corporation tax. So when they want to pay corporation tax, the cost of that, like how much they have been paying to service their loan, that particular cost is tax deductible, meaning that there's no tax charged for the cost of that. So that is why we put in this bracket 1 minus tax rate, because only that is tax deductible. We don't put it for equity because dividends, which are the return from equity, okay, dividends are not tax deductible. Dividends are taxable. So that is why 1 minus D should only be that. So please jangan pandai-pandai gila tak 1 minus D here. Equity is always taxable. Okay. Alright. So that's first how to calculate. Okay, so now after you have known, like you've known how to calculate, right? Then your next question would be, okay, so now why do I need to know about this thing called MAR and hurdle rate? Okay, so MAR is this thing called minimum acceptable rate of return, which is the minimum rate of return required by the company. Okay, so if you remember at the early on when I started the sharing session, right, I mentioned to you that you need to be better off by undertaking a certain project. If you are worse off by undertaking a project, you should not do the project in the first place. So how do you want to know you are better off or you're worse off? You have to have a benchmark. So this is somewhat like a benchmark to be set that a company can set, which is called a minimum rate of return. For example, a company sets its minimum rate of return at 10%. Okay, after undertaking a project, or say the project return is less than 10%, which means I cannot undertake the project because minimum I have to get 10%. So that's the basic concept. Okay, so this is also known as the hurdle rate because apparently MARR is very long, okay? So you just call it hurdle rate. So this is what happens. Management will usually set, okay, we will need at least this kind of return. And the relationship with WACC is, okay, this is what normally will happen because for companies, right, they normally don't macam want to complicate matters lah, okay? They will just set the WACC to be the minimum acceptable rate of return. So as long as this can cover the WACC or the capital invested, the project can be accepted. But let's say if, for example, there are other factors. Okay, other factors ni, for example, okay lah, if it's a government project, nowadays what happens is government will do infrastructure projects and they will ask a private company or a berhad to do the project on their behalf. Government will just provide the financing, right? So there is a risk that, for example, government changes. When the government changes, the new government may not want to proceed with the project. They might want to cancel it. So then you, as the company, will then face a risk that the project might not proceed. So then those are like the other risks that you have to undertake lah. Okay. Yeah, so far. Okay. All right. So that is the end for the WACC part and the minimum acceptable rate. Okay, now we move on to project analysis. Okay, so now these are like terms that you might have been familiar with when you read the project assignment. So you have like life cycle cost, work breakdown structure. Okay, so let's go to life cycle cost first. Okay, so life cycle cost is basically this diagram you see on the left. So you have this thing where you will look at the cost of either running a project or owning a facility by going through the stages that are involved with the project. So these are like the stages. So initial, at the beginning, how much do I have to pay? How much do I have to pay for my machines, for my materials and all that? Service cost is something that happens during probably the construction or probably during the completion of the project. Okay. Preventative maintenance is this one, of course, I think you know this much better than I do. This is something to do with like when you already have for example, a building or infrastructure, you need to have a certain cost dedicated to preventing certain defects or certain defects from happening, right? Like your maintenance lah. Then you have your operating costs and your disposal costs. So this is one of the approaches used to calculate. You will have like numbers here. So initial cost berapa, service cost berapa. So everything you total up, you get the total cost. So this is important because when you know your total cost, then only you are able to make an informed decision on how I want to finance my project. If I don't know how much my cost is, then I cannot really decide, right, how much I'm going to finance and so on. So this is very important. Although it looks very simple, but it's actually very important. Okay. So when do I actually use this, right? Okay, I usually use LCC when a project comes with multiple alternatives and all of them actually meet the same outcome. So for example, you want to build, say, an infrastructure project. For example, smart tunnel, right? And then you have like certain approaches to construct the project. Not necessarily you buat satu cara je, you can do a few ways. And then, so what's the difference? So the difference is probably approach one, initial cost is lower, tapi operating cost is higher. Alternative two, maybe disposal I lower, tapi service cost I higher. So you need to find a way that when I compare all the alternatives, right, I can actually maximize savings. Because at the end of the day, I don't want to come up to this outcome where I have to spend so much. When I spend so much, I have to get the financing, which is a lot. That will be a problem to me lah. Okay, and you have to do this at the beginning of the design process. Because, okay, of course, again, as engineering students, I'm very sure you're familiar with this. Once you have conducted your design process, you've completed your design and whatnot, and then only you want to do this, it's very difficult for you to maneuver, right? You want to change your design and all that. I think it will be very difficult lah. So you need to do this as you are designing your project. So you design, okay, I'm going to do this kind of structure, I'm going to do this kind of enhancement. So you have to start thinking, okay, how much will my enhancement cost? How much my operating cost will be? Can I dispose this at a lower cost? Something like that, right? So it has to go hand in hand with your design process lah. Okay? All right. So that's your first project analysis tool. Your second project analysis tool is called the work breakdown structure. Okay. This is I would say work breakdown structure is very teratur lah. Okay, teratur lah, we call it. Right? So it takes a step-by-step approach. So we will take a project, we will like go step by step. So first, you will look at the scope of the project. So the scope, for example, okay, I want to make sure that I build a certain building that meets certain criteria and so on, right? Then I will set my boundaries. Boundaries mean, for example, my cost cannot be more than this. My building has to be located at here, and then my materials have to be a certain quality. So those are my boundaries. And then I have to identify my deliverables and all this. So until the end, so it seems very technical, right? But I'm sure when you identify your project, when you decide on what you want to do, and it's easier for you to apply this. So when you use your work breakdown structure, you can either do a deliverable base or a phase base. Okay, so what I mean by this is probably I can illustrate better with examples. Okay, so for example, this is like a construction project that you want to undertake. Okay, so if you look at the first example, you have 1, 2, 3, 4, which are like your phases. Your first phase, which involves your pre-construction. So you want to mobilize your resources, you want to mobilize your machineries. Probably your machineries all are at location A. You want to go to location B. So all that will incur costs. Then you have your earthwork, your piling and whatnot, right? Then you have your structure. Then you have your road and bridge. So these are like phases. Whereas if you do a deliverable base, you will identify, like, for example, okay, first, I have to make sure my plans and specifications. Second, I have to make sure my structure. Then third, my exterior. Exterior means all these things. So it's like apa yang I kena deliver. Whereas the first one is the phases, the steps involved. So phase 1, phase 2, phase 3. So you can do either this phase-based or deliverable-based, whichever is better suited for your project lah. Okay. This is an example. Okay, this one is something that I just looked up because I believe it's something that maybe you're more familiar with, something like waste, water and treatment plants. So this is also an example of a WBS lah. And it's very, I would say it's very specific, probably coming from a non-engineering person. I see this is very specific lah. So this is something I'm sure that you can also produce even better, perhaps. Okay, but again, can't stress enough, WBS is very important, especially when it comes to construction and design projects, because they can make sure that your work becomes very teratur. Kalau tak, then when you start designing something or when you start constructing something, you will come to a point where at the middle of your project, you kind of all right.
Okay, Tasha, boleh?
Okay, boleh. Sorry,
Okay.
I think my internet got disconnected.
Okay, it's okay.
Okay, sorry, we were here just now, okay? Okay, right. Okay, so cash flow diagram. Okay, as I was saying, there will be certain cash flows, okay, being either you have to incur certain costs or you will receive certain cash during different points in time during your period of the project. So cash flow diagram is something for you to use. For example, like, okay, year 0 means at the beginning of the project, right? So you will be able to put here, okay, 175,000 initial cost. Then from years 1 until 8, you will be incurring 19,500 annual operating costs. Then at year 6, because probably this is something to do with your maintenance or something to do with your servicing costs, you will incur another 122,000. At the end of the project, usually you will have a salvage value. So this will be a positive inflow. So usually cash flow diagram, you will use this to calculate how much at the end will my total cash flow be. So this is just basically adding and subtracting lah. So it's not very difficult for you to use in terms of analyzing your project. Okay. All right. Okay. Moving on. Okay. Okay, I know the diagram looks very similar, but here we are looking at a different method. So this is where we will learn in terms of net present value method. Okay, so if you look at the diagram, right, it's basically still the number different points in time during your period, the period of the project. You still have your initial cost, your annual cost, your salvage value, and so on. But now, how do we calculate the net present value of the project? Okay, and for you to calculate net present value, you basically have to learn something called a discount rate. Okay, why do I say we have to learn something called discount rate? Okay, basic concept is this. Today I have 100 ringgit. Okay, I can buy something worth 100 ringgit today. But if the 100 ringgit that I have today, I keep for 1 year, what is my 100 ringgit worth in 1 year's time? Can anyone tell me? Any wild guess? Okay, 90. Wow, so your discount rate is 10% lah. Okay lah, fine. So he got the concept right. Basically, usually this is because of inflation lah, okay? Because things will get more expensive, right? Usually, normally, inflation happens, things will get more expensive. So the time value of money. So this is called a concept of time value of money, where my 100 ringgit today will not necessarily be 100 ringgit 1 year down the road. So that is why I have to apply this thing called a discount rate. Okay. So this is what you will use, and this is what you will prepare using the figures earlier. So you will calculate the net present value based on how much cash inflow you have, what's the discount factor, and what is the present value. So present value, because, for example, my 30,500 cash that I will get in year 1, okay, today I am valuing it at 30,500. But because of my discount factor, the 30,500 I will receive in 1 year time. But because of the discount factor, presently it's only valued at this 27,727 ringgit. Okay, so basically if you use Excel, it's just this figure discounted by this figure dapat ni. So ni bahagi ni dapat ni. So you just do it throughout the years, then your total is just a sum of all this. So you get a total which is a positive figure, right? Okay, so what do you think? If you get a positive NPV, what does it mean for you to decide whether to undertake a project? Any guesses? Can.
And
Okay.
continue with the project.
All right. Okay, so yes, correct. If you get a total PV which is positive, which means you can decide to proceed with the project. But again, as I mentioned earlier, there might be situations where you get a negative, oh sorry, you still get a positive PV, but the project comes with risk whereby there's a possible government change in government regulation and so on, risk that cannot be quantified. Okay, they call it qualitative risk. So you have to also consider whether the qualitative risk may outweigh your decision in proceeding with the project, notwithstanding that your present value is positive, right? So the point here is not everything is about numbers. You still have to do some analysis in terms of the qualitative aspect. But of course, numbers are like the first thing that you calculate lah. Okay? It's not like you keep the numbers and you go always straight to like, oh, okay, regardless what my number will be, but I just don't want to take the project because anyway, government can change, right? So I don't want to take the project. You can't do that. That's a very simplistic analysis. You still have to calculate the present value and then take into consideration other factors that might affect your project. So that will be a stronger analysis lah. Okay. All right, so that's NPV. Okay, are we all clear on NPV? I believe this is something quite important for your report. Okay, so if anything, again, can always refer to Dr. Hazrin. I'm very sure she'll be more than happy to assist you on this. Okay. All right. Then the second financial tool that you can use is called a payback period. Okay, payback period method ni is much simpler compared to NPV just now. NPV tadi you have to factor in the discount rate and so on, right? Payback period method is just basically how much time do I need to recover the cost that I have made? Or as an investor, how much time do I need to reach a point where I come to break even? Break even means I don't incur profit or losses lah. Okay, so that's the formula. The formula is just for you to understand and probably to use to calculate. But what I'm going to do is I'm going to use a work example for this, okay? It can help you to understand better lah. Okay, so the question here is, assuming firm A invests in a project to treat wastewater. So they incur 1 million initial cost. Okay, in year one, firm A expects to receive 150,000. This is already net of cost, so this is already net income. And the expected cash flows, again, net of all costs, is projected to grow at 5% annually. So how long will the payback period be? Okay. So the workings are quite simple actually. If you look at it, okay, I started off with all the inflows first. The initial cost, the one that you're going to spend, I letak kat bawah. So year 1 to year 6, I calculated all the inflows that we will get. So for example, okay, the trick here in the question is the growth rate. There's a 5% growth rate. So not every year is 150, you will grow at 5%. So if you look at this times, this is the growth rate. And the growth rate is compounded. You remember just now we talked about compounding, it adds up, right? So this is also an example of compounding. So in year 2 is just 5%. In year 3 is 5% to the power of 2 because it's already 2 years. Then year 4 is already 3 years, so they compound. So when it compounds, you see the number gets larger and larger, right? And then total inflow, I will minus with my initial cost. Okay, so you see my payback period is actually at year 6. If let's say I stop at year 5, will I be able to recover my 1 million ringgit cost? If I don't recover, then my payback period is definitely not 5 years because I still have some costs left to recover at year 5. Okay, so you see, payback period is much simpler than NPV. But why in working, in actual working experience, we don't normally use payback period because payback period, one is which we don't factor in the time value of money. We just take the value as it is. And secondly, it's just telling you how much I will recover in how many years. But aside from that, I don't get any additional information, you see. So my NPV method just now is much more realistic and it gives much more information for me to use when it comes to my financing decisions. Okay. All right. Now, okay. This might be a bit, not to say heavy, but I just want all of you to understand how do we incorporate three different concepts of finance in one example. Okay, so remember we've learned about CAPM, where we talk about cost of equity. We've talked about weighted average cost of capital, where we have proportion of equity to debt, and we also talk about NPV earlier. So let's say this is an example of a company that wants to invest in a project and how they want to do the financing decision. Okay, so here you have company A. Company A wants to venture into sustainable investments and they want to probably participate in government tender involving construction of a green building within the client value. So typically how they do is they finance the project 60-40, which is 60% equity and 40% debt to minimize finance costs. Because probably for this company, the dividend rate is not so high, so they can issue more equity and probably the cost of loan is higher. For some reason, maybe banks are not so keen to give them a loan lah. So they minimize the debt. Okay, so they've also given you the 10-year Malaysian government securities bond yield is 4%. Okay, can anyone tell me why do we need this information? Not sure. Wow, first time I'm getting this kind. Okay, all right. Okay, so 10-year Malaysian government securities bond yield is called the risk-free rate. It's a proxy of the risk-free rate because Malaysian government securities bond is basically Malaysian government is issuing you a bond. So Malaysian government is telling you, I need the money from you. I will give you a bond. In 10-year time, I will pay you back the bond, right? So Malaysian government bonds are usually very guaranteed because government kan, of course government got money to pay you lah. Kalau let's say it's a company that is quite small, they may or may not pay you back. But government is quite guaranteed. So this is why we call it a risk-free rate. Okay? Clear on this, huh? Right. Then you have the beta. The beta of the company is 1.2. The equity risk premium is 8% and the cost of that is 6.5%. Okay, then they give you further information. Company A anticipates to incur outlay cost of 500,000 at the beginning, mainly comprising materials, labor, and machineries. Annual cash inflow of 100,000 expected with a growth rate of 5% for a period of 6 years. So the question is simple. Should company A proceed with the tender or not? Okay. So this is, it looks a lot, right? But actually, if you look at how, okay lah, it looks a lot also, but it's probably not so much. Okay, let me just walk you through the steps, okay? There's just 3 main steps to it. Step 1, you have to calculate the cost of equity using CAPM. Okay, so cost of equity here, if I go back, so remember, 10-year Malaysian government securities bond yield 4% is risk-free rate. So risk-free rate is here, your RF plus your beta 1.2 times your equity risk premium. So you get 13.6% of cost of equity. So 13.6% is the return that you have to pay to your shareholders. Okay. If, for example, you decide to just finance your project 100% using equity, you can stop at step 1. No need to do step 2. Then you can go to step 3. Okay. The reason why we do step 2 is because this company decides to do a 60-40 proportion of equity and debt. So it depends on you really. If you decide to do both, then yes, you have to calculate WACC, which this one I believe Dr. Hazrin will brief you further in terms of what the requirement for the report is. But I'll just walk you through how you want to calculate the weighted average cost of capital. So for this company, 60-40 proportion, 60% equity times the cost of equity. Okay, this is something that even during my uni days, we usually face this kind of error. Sometimes students tak perasan. dia ambil proportion of debt, dia darab dengan cost of equity. And then dia ambil proportion of equity, dia darab dengan cost of debt. So this is something you have to be very careful. Make sure that it's properly matched. Proportion of equity, proportion of debt, cost of debt. Then you get your weighted average cost of capital. Okay, this is something I highlighted because this is something very important for you to understand. When you come to this figure, I can assure you will sit back and you will think, or you probably will pause. Kenapa ada figure ni pun? So when you have that question, always remember your WACC figure is your discount rate. So remember just now we talked about NPV, there's a discount rate. Okay, so this is your discount rate for any projects to be undertaken by the company, assuming, this is also important, assuming your proportion is the same and your cost of debt is the same. Katalah, for example, the company tiba-tiba has a different cost of debt and a different proportion. Then you have to recompute back your figures. Okay? But again, your computed WACC is your discount rate. So this will remain the same. Okay. Then at the end, when you have 13.6, 10.76 and all this, you will go to your NPV. So NPV again, very simple. This is something I just did in Excel. So you just take your cash flow. So for example, cash flow in year 1, you expect to get 100,000, discount it with your 10.76% discount figure. This is your present value. So when you total up everything, you get a negative figure, right? The one in red. So now you ask yourself, should I proceed with the project or not? So technically, normally, you will not proceed because you now are worse off by undertaking the project. If you undertake the project, your company will have to incur some more, 24,020 figure. So of course, normally a company will not want to proceed with the tender. Okay, so everything is actually just for you to understand, or is to assist you to decide, do I want to proceed with the project or not? That's the only question that you have to ask yourself actually. The rest are just guiding tools for you to come to your conclusion. So in your report, I believe that's also how you have to like probably put down in terms of explanation and all what, so that your report becomes meaningful and it shows that you really understand the subject matter. Okay? Okay. All right. I'm sure you must be very relieved also. This is the last part of the sharing session. Okay, this is more for, because I believe your International Construction Week, the theme is in terms of sustainability and sustainable construction, engineering, finance and whatnot, right? Which I really applaud UTHM for taking such a theme, where this is currently like the main thing that we're focusing in terms of capital market also. Okay, so what really is sustainable finance? Okay, usually when we talk about finance, it's always about profit. It's always about, if any one of you have watched Wolf of Wall Street, you will look at how people dealing in shares and becoming brokers are always painted as people who are greedy for profit. But this is where the current situation is slowly changing, in the sense that we are moving towards something that is sustainable, that is caring more for the environment, looking at more social and governance responsibility. So if you look at the pillars of sustainable finance, right, the three main pillars here, I think CSR is something that you've probably heard of it, you've probably participated in it, like your university activities, right? You've looked at probably going to, pick up rubbish. It may sound very petty, like, oh, you pick up rubbish somewhere, right? But picking up rubbish is something that actually contributes to sustainable finance. Because, for example, I give you an example. You go and pick up rubbish somewhere. You will be going there via buses or whatever, right? So who is actually paying for those buses and all that? There might be some big corporations that sponsor your CSR activities. So these corporations, in a way, they undertake these activities so that they can contribute to making the environment a better place. But you feel that just as a student, you're going there and you're just doing something that, alah, ini je kita buat. But you need to know that this is a part of something bigger lah. Okay? And then there's also this thing called sustainable and responsible investing, SRI. So SRI is something that we do also in the SC on a quite frequently now, where we come up with certain guidelines and framework to support investors. Because, for example, you want to ensure that people invest in sustainable companies, that they don't just invest in companies that are merely for profits, but the companies need to contribute to the betterment of the environment, social and governance, which leads to the last one. So the last pillar is ESG. ESG is basically like criteria. So for example, nowadays like it's always about diversity, or you want to make sure that there's equal treatment, male and female. You know, you have to have enough female directors in the board of a company. You have to have enough female employees. Especially, I think engineering sector is probably still very male dominant. So you want to encourage female participation. And another part of it is always about when female goes for maternity leave, how does companies support the return of these mothers to the workforce? So these kind of things are like criteria that we look at when we want to measure their ESG impact. So if a company macam, sometimes you've heard of this, probably mothers after giving birth, they take 3 months off. Then some companies, they even allow the mothers to take 1 year maternity leave. To the company, it might be a loss because, I don't have this person to work for me. But as a whole, it just shows that how the company is able to support the mothers in the workforce. Because after 1 year, probably the mother is more prepared to come back to work rather than just, 2-3 months macam tu. So these are all part of sustainable finance lah. Okay. So, these are like considerations in terms of environmental, social, governance. Okay. The reason, I know it's a bit it's a bit compact, but the point I want to make here is that in terms of sustainable finance, right, there's 3 parts to it. There's green finance, social finance, and governance finance. So for example, if you want to undertake a project that is sustainable or is contributing to the sustainability aspect, you not necessarily have to look at environmental. You can also look at social finance or governance finance. So for example, a certain project of yours can actually contribute to the inclusiveness or the investment in human capital. So this is also part of sustainable finance. But most of the time, probably for engineering purposes, it's always focused on environmental, on the green part. Because usually you are able to build something that can address climate issues or can address certain things that contribute to the environment, right? Like biodiversity and so on. So this is more for your own information. So when you decide to do a project, you can give more context to the project lah, okay, in terms of sustainability. Okay, and this is just for your information also. So remember just now we talked about bonds, how there's like bonds issued for financing purposes. So we have this thing called sustainable bonds also. So if you look at sustainable bonds, if you look at green bonds also, like green bonds in green, right? It macam memang is like the hot item in the market now. So everyone wants to participate in green bonds. So basically these green bonds, sustainability bonds are all part of the investing trend because people don't want to just invest for the sake of getting returns, but everyone is already having increasing awareness towards making the world a better place lah. Okay, generally that lah. All right. Maybe I'll just share a bit on the developments in Malaysia, but maybe I'll not go to the link. I'll just probably just verbalize it a bit. Okay. One of which what we're looking at is this thing called SRI taxonomy. So sustainability and responsible investment taxonomy, which is a set of criteria to guide investors to invest in companies that are sustainable. So in the SC, there's also departments looking at this. So to make sure that investors are aware. So our job really is to create awareness for investors out there. And second, to ensure that there's clear framework because we cannot allow every company to declare themselves as, we are ESG compliant. So everyone will just say, I'm ESG compliant. But siapa nak check they are really ESG compliant or not? So that's our job to check whether they met certain criteria and all that lah. Okay. All right. So, I think this is the last one. This is your group project assignment. So I've just put this in for you to, I'm sure that by now you are already very aware of this. So this is just something that you have to prepare and so on. So all that I have shared earlier actually relates to the contents of your feasibility report. So all the information I have shared and basic calculations and whatnot is supposed to assist you to prepare this report, right? And I think all in all, maybe just one, if I'm in your shoes, maybe just one thing I would advise is that when you prepare a certain report or when you want to decide on a project, try not to make it too academic. For example, not just take the facts from the book and just put it in the report. You need to think of how to make it very meaningful in a sense of make it realistic and you have to analyze it. So putting facts, right? Anyone can just put facts in the report, but how do you make the best out of the facts that you have, the knowledge that you have, that will distinguish you from the others. Okay. All right. So that's the last one. There's any questions or anything that you might want to ask?
Okay, thank you, Natasha. Okay, anyone have a question for Mrs. Natasha regarding your project or anything about sustainable finance? Any question? If you ask me during the class, I will ask again why you ask me, not Miss Natasha. Okay, any question? Okay, or in the chat box, we have any question? No. Okay, so maybe I just ask the question, Natasha. Okay, how can we get the data for CAPM or WACC equation that have like the value for beta and everything that you have in your question just now? Okay, yeah, that one for beta value, everything. Can my student just Google it or any website that can help them to have all this
Yeah,
data?
okay. Actually, for our data gathering purposes for work, we actually use Bloomberg. So I think Bloomberg is a paid platform. We have to pay for subscription. But normally what you can do is, yes, of course you can Google. If you know certain companies, like the famous companies, the bigger ones, I believe the data is publicly available. Um, for example, like equity risk premium is basically the expected return from the market minus expected return from the share, right? This one also, if you Google, you can get it based on, like for example, I mentioned just now, KLCI top 30 index, that is the return from the market. And then you can minus off with your risk-free rate lah. So you will get your equity risk premium. So most of the information are publicly available. If you are not sure at any time, I would suggest to use this tool called Investopedia. It's called Investopedia, so you can use Investopedia. Or sometimes I believe Bloomberg can also help, but I'm not sure because we've been using the paid one. So if it's the free one, I think they might have some information, probably a bit limited lah. But it can help you to come up with the numbers.
Okay, all right, thank you. Okay, maybe we have like last question, final question from Hanif Izani. Okay.
Okay.
Yeah.
Yeah,
Can you see the question?
okay, yeah, I see. Alright. I believe Hanif, right? Okay. I think based on this is like purely gathering from what you have responded and asked. I think you already have some preliminary knowledge in finance. That's why, and hence probably that's why you are quite interested. Okay. I wouldn't say, okay, again, because I'm not from an engineering technology background, but I've seen my friends who are engineers by background. They are engineers by virtue of degree or masters. But after working in engineering companies for 2 years, they feel that what they have been doing is just designing projects or coming up with the structure, but it's just that they stop there. After that, what happens is, say for example, the finance team will take it on, and the finance team, to minimize costs, they will change the design of the project macam sesuka hati because they want to minimize the cost, right? So when it comes to implementation, the engineers will be like, we didn't tell you to do this. Like, we didn't tell you to pick this material, or we didn't tell you to do this kind of design. We gave you different. But the finance team, not knowing what the implications are, they just change it. So I don't Okay, so back to your question, I don't think it's more of it's not a specialization in project finance. It's more of you use this knowledge hand in hand with your day-to-day job as an engineer or someone from engineering background. Because if, for example, you don't have enough of prior knowledge on finance, on project finance, and everyone is aware of that, they will take it that your job only stops at designing the technical aspect of the project, and they will take it on from there. So you will have no say whatsoever. But if you demonstrate to them that, okay, look, I also know this part, so they will include you and you can share your views, your thoughts and all that. So that makes you a bit more, not to say special, but at least if I put it in layman terms lah, you tak sakit hati lah tengok orang lain just take your project and you just go and do it. That would be my advice. I think, okay, if I can just give you another example. When I started work, I had to learn all about laws and regulations because my day-to-day job is about regulation, right? I have to learn companies law, I have to learn the capital markets law, which is something that I didn't do in my degree years. So it's not to say that I have to specialize in law just because I work in the regulatory side, but I need to know enough so that I can contribute meaningfully to my work. Or else then everyone will be like just the lawyers lah who can contribute, right? Accountants will not have a part in it. So that same goes to you. You need to know what can you do with the knowledge. Okay. All right, I see another question.
Yeah, another question.
What steps? Wow.
Credit, wow, ini untuk like
Securities.
for his future, I think. Okay.
Okay. All right. Okay. Before I respond to Hanif, I just address Amirul's question. Healthy credit profile, avoid negative marks. Okay. Of course, first of all, please pay your loan on time. Not just loan, credit card. If you have credit card payments and you just leave it there for months and just ignore it, that will of course leave a negative remark on your secrets. That's for individuals. For businesses, for businesses it's a bit different because of course businesses have a bit more to manage. What we've seen before, right, like real life cases, usually businesses have this attitude of overgrowing, like overexpanding. When they overexpand, not realizing that they don't have the financial capacity to do so, they will tend to take more and more loans. So simple example, you are still growing. So when you're still growing, people might not want to give you so much of loan. But you keep on wanting to take more and more projects. So if you're a small company, you need to know where to stop, right? So steps that you can take to do that is probably to manage. So for example, in one, I can only undertake this many projects total with a total of this much cost so that I can only take loans of this much. So I can pay back my loan in time, I can manage my interest costs and so on. So it's more of managing. You need to know how to, like where to stop and how to manage. Because, and I think it same goes for individuals, right? Like when you start to have higher income, you start to think that you can spend more. Not naturally, I'm seeing it from myself also lah. You tend to think you can spend more. But actually when you do that, you don't realize that you are actually affecting your spending habits in a way. Like you have to know your limit. So I think the best advice is just know your limit, and that will probably hopefully help to maintain your healthy credit lah. And I hope that you don't ever have to face that because once you have that negative remark on your CCRIS, it's very, very difficult to get housing loans and all types of financing facilities. So it's very important, especially at a young age, to just make sure that you don't face that lah. Okay. Darshini has a question. What happens if the project is abandoned? How do they pay back? And how? Oh, okay. This is something we've also seen before. And normally, this what happens with the affordable housing project. Okay. If the project is abandoned by the developer, first of all, you must know that when the developer decides to commence construction, they will of course have to enter into several legal agreements. So they will have agreements with the with the authorities. They will have agreements with the house buyers, right? So, you know, if you buy a house which is about to start construction, you will sign an agreement, and the agreement will say by what year will the developer complete construction and hand over the keys to you. So, some, you know, if the project gets abandoned, the developer is deemed to not fulfill their legal obligation. So one is legal repercussion is that they will probably face lawsuits from the house owners, the house buyers, right? Because you have promised to give me a house, I have already started paying interest and whatnot. Suddenly the project gets abandoned. So who's going to pay for my cost, right? So you will probably get sued. Second, of course, reputation. Your reputation will just be very dented lah. You know, the developer will be known as someone that buat rumah and then just tinggal, right? Okay. In terms of loan, of course, naturally, if the project gets abandoned, they won't pay back the loan lah. And probably that's one of the reasons why they abandon lah, because they just cannot pay the loan. If they don't pay back the loan, remember I mentioned that the bank will take a collateral. So this is where usually banks, they will of course take a collateral, or they will take some form of a guarantee. So we've seen before, like company will pledge probably some form of money or probably some assets to the bank. So once the developer doesn't pay in time, or you know, not just pay, the bank will give you certain covenants. We call it covenants, like some limit lah. Okay, your financial cannot be how do I say this in a non-financial, like, okay, like your debt cannot be more than this, your interest cannot be more than this. So you need to make sure that you meet these limits. If you breach one of the limits also, the bank will straight away enforce the collateral. So they will take your house, or they will take your car or anything. So that's what happened when they don't pay back the loan lah. This is very important. I think one point to this is that it's very important for you. I think this is for your future lah. When you want to decide to buy a house or anything, please really do research on the developer. Please do not just simply go and buy from any developer. This is very prominent nowadays. I think if you read the papers also, like Kementerian Perumahan has always mentioned how many projects have been abandoned, and they publish the list of developers also, so that there's awareness to the people out there lah. Okay, hope that answers your question.
Okay.
Thank you, madam.
All right. Okay, I think that's all, already 4 p.m. I think, our session. Thank you so much, Natashya.
Thank you so much
Okay.
for allowing me to share. Yeah,
Thanks
hope-
again.
Okay,
Thanks again. Yeah. Thanks again for the informative and interesting talk. And I hope that this sharing session will be beneficial for everybody, especially engineering economy student. I hope all the explanation or the sharing from Natashya can help you to do your project. Okay. All right. Thank you. I think that's all for slot 4. Okay. Okay. Assalamualaikum and goodbye.
Thank you, everyone. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.